Bitcoin's interesting because it's kind of the first time where we invented fast settlement, which is to say that as long as the network remains reasonably decentralized, I can send you value, and within 10, 20, 30 minutes, your Bitcoin is confirmed on chain, and I have no way to pull that back. It's kind of final settled unless the majority of miners decide to start reversing transactions and things like that. And so that's kind of the first true possibility for finding that solution. But then, of course, it has to go through this very long process of being tested, right? So then people make thousands of other cryptocurrencies and they say, well, can these do it better?
Bitcoin's network has shown remarkable resilience, reaching an all-time high hash rate of 679 exahashes per second on September 7, 2024, despite its price dropping below $55,000. This underscores the network's strength and stability, particularly given the current price challenges. Investment expert Lyn Alden, in a recent interview, credits much of Bitcoin's robustness to its decentralized network and robust security features, which are crucial for enabling fast settlements. Alden stresses the importance of understanding who controls the ledger to prevent monetary devaluation, pointing out central banks' asset preferences and the reliance on physical currencies in developing nations. As Bitcoin grows, its decentralized ledger continues to be a key factor in its appeal and potential for future growth and adoption. She also highlights that Bitcoin's ability to facilitate fast settlements has inspired the creation of numerous alternative cryptocurrencies, all seeking to enhance its design and efficiency. Nonetheless, Alden acknowledges that Bitcoin remains a small market compared to the global fiat money system. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
Gold and silver have kind of like an inbuilt difficulty adjustment, which is that our technology gets better at finding them over time, but we've also mined a lot of the easiest deposits. So the deposits are getting harder, our technology is getting better, but we're not really increasing the supply too quickly. And if you look at gold over the past century, it's ranged between, and this is like World Gold Council data and US Geological Survey data. There's a couple different data sources you can look at, but gold supply is estimated to increase by 1% to 2% per year on average. And it's been a fairly tight band. You have to go back to the gold rush to find when we kind of meaningfully broke above that. And that was in large part because, again, an industrialized culture was coming to a continent that had not been industrialized yet. So they had a lot of low-hanging fruit to pick, kind of in terms of gold mining for at least a period of time. And so basically through the process of iteration, societies came to see that gold and silver are the best ones. And the main reason why silver held its value is because gold's key limitation was divisibility. Even a small gold coin was worth more than most purchases. So silver was kind of the more daily use metal. And so this only became challenged in the telecommunication era because prior to telecommunications, speed didn't matter. All commodities kind of moved at the same speed. Things like coinage could help speed up the act of weighing and verifying a given commodity. But other than things like that, there wasn't really a big speed difference. But in the telecommunication era, we started to send, and that started in like the mid 1800s with the laying of the long distance telegraph cables. We started to do commerce at large distances very quickly, and so we started abstracting and paperizing everything, and we started kind of getting liftoff away from gold. And so it's kind of the first time we pivoted from a stronger commodity to a weaker commodity, kind of the dollar, like this ledger system it's actually less sound. We spent thousands of years always getting more and more sound, from shells to tobacco to silver to gold. And we kind of started reversing because speed was a new variable that mattered. So yeah, it's not an accident that humans settled on gold for so long. It's because it's the commodity with the highest stock to flow ratio. So how much exists compared to how much can be produced in a year. And so it's obviously got very good properties for how much value density you can store in it. How long it lasts when stored. Basically, it's not an accident that all of its properties line up to be good money, and then therefore it's used as good money. And so the way I put it in the book is that fast transactions are an easier problem to solve than fast settlements, right? So if you have Morse code and telegraph, you can do fast transactions. Two people can talk across the Atlantic Ocean and agree on a transaction. And then the settlement is the hard and slow part, sending and verifying gold. Even in the modern era, when Germany repatriated its gold, they expected it to take like 7 years, and they were happy that it only took like 4 years, which is it's kind of a comical number, and it costs millions and millions of dollars worth of logistics and security and auditing and all these things. Settlements have been a problem. One of the things I cover in the book is that Bitcoin's interesting because it's kind of the first time where we invented fast settlement, which is to say that as long as the network remains reasonably decentralized, I can send you value, and within 10, 20, 30 minutes, your Bitcoin is confirmed on chain, and I have no way to pull that back. It's kind of final settled unless the majority of miners decide to start reversing transactions and things like that. And so that's kind of the first true possibility for finding that solution. But then, of course, it has to go through this very long process of being tested, right? So then people make thousands of other cryptocurrencies, and they say, well, can these do it better? Can someone find a way to hack it? Or how can it be updated over time to be more efficient? And all these things kind of happen, and it's still a very small market. It's only $1 trillion plus market cap in global fiat money is something like 100 trillion.
Lyn Alden points out that while Bitcoin's decentralized ledger enables fast transactions, slow settlements remain a concern. She notes that central banks prioritize speed when managing assets, favoring easily liquidated treasuries over gold due to logistical challenges. Similarly, individuals often prefer faster value storage options like the S&P 500 or real estate. However, Alden highlights that these alternatives may not be accessible in developing nations, where physical dollars or gold are more commonly preferred. Alden emphasizes the importance of knowing who controls the ledger, as trust is crucial to avoiding monetary devaluation. She also discusses Egypt's expanding money supply, which leads to a 20% annual devaluation of the Egyptian pound, and how this erodes trust in the nation's financial system.
And I think it's a very powerful solution, but it obviously takes time for the market to test it and adopt it. And so as long as we're still in this world where Bitcoin is small, fiat is big, we're still kind of in this weird limbo of fast transactions, slow settlements. And one of the things you see is that both on an individual level and on a national level, they consider speed to be a variable. So a central bank holds treasuries in large part because they can liquidate them in any kind of business hours. They can just say, we want to sell the treasury and buy back our own currency. Whereas if they're holding gold, it's the logistics of saying, hey, we just want to sell $10 billion worth of gold right now. It's hard to do logistically. And so they do hold it for a portion of their savings, the part they don't really plan to touch anytime soon, whereas they hold other assets that are faster. And for individuals, they start monetizing things like the S&P 500 or oceanfront real estate or lakefront real estate or fine art, right? There's these other monetary things that kind of compete with gold, even if they're not really money in the traditional sense. They're things that they become our primary store of value. They're more efficient. They are powerful. But a lot of people, especially in developed markets, forget that in developing markets, that's not always available. A middle-class person in Egypt can't easily buy the S&P 500, for example, and their local stock market does not have the same long-term store of value properties. And so in those markets, they gravitate toward physical dollars, ironically, or they gravitate toward physical gold. And these are still kind of stores of value in those societies.
Why is understanding who controls the ledger very important, Lyn?
Right. So when we think of money, at the end of the day, it's kind of a ledger, right? In either the literal sense or the abstract sense. So, you mentioned barter, for example. An example I use in the book is that when I was a young engineer, we would often go out to lunch, like me and my coworkers would go out to lunch, and we kind of take turns driving. And if someone at lunch doesn't have like enough cash on hand, back when people paid with cash more often, they would just say, "Hey, can you just cover this and I'll pay back tomorrow." Everybody kind of keeps track of this ledger of who's driving enough, who's not driving enough, who's who owes who money. A lot of things are just kind of solved by having this like mental ledger, this kind of informal mental ledger between us. And that's how a lot of hunter-gatherers do it as well. There's basically this kind of like family and kin type of arrangement. As things formalized, we started putting things into literal ledgers. And commodities also serve as kind of a nature-governed ledger. So if we, for example, trade around gold and silver coins with each other, we're using nature as a ledger. We're using the fact that nature has kind of this governing process on how hard is it to mine gold and silver? What do you have to do to get more of it? What are its properties? So we're kind of trusting nature that those properties are going to remain consistent. That sometimes is violated, like in those other commodities, they were fairly consistent, but then new technology comes along and they can kind of cheat the ledger, at least compared to everyone else's technology. So far, gold and silver has been really resistant to that, which is why they're still monetary commodities. And so either whether trusting nature to run the ledger or trusting humans to run the ledger, we're in this environment where in order to not get our money diluted, we have to have some trust in the ledger that we're using. And in the modern fiat currency era, that's a trust that's commonly violated. So in Egypt, for example, I keep using Egypt because I live part of each year there. They've got over 20% structural money supply growth year over year. And so if you're holding Egyptian pounds, and many people still operate in a cash economy there, especially on the lower end of the income spectrum, it's not a heavily banked society. There's the middle class and up is generally banked. Some of them can earn interest on their bonds, things like that. A lot of the lower class is really just moving around cash, and they're storing cash as their savings. And this unit is getting diluted at 20% per year or more. And so they're kind of trusting a ledger that's getting kind of weaponized against them.
Lyn Alden emphasizes the major advantage of Bitcoin's rapid settlement capabilities in the financial sector. Unlike the slow and expensive process of settling gold transactions, Bitcoin enables confirmations within minutes, thanks to its decentralized network that ensures transaction finality unless the majority of miners vote otherwise. Despite a recent drop in the hash price to below $40, one of the lowest levels this year, miners remain committed to increasing their computational power, driving the network to new milestones. This determination reflects the resilience and dedication of Bitcoin miners. The recent surge in Bitcoin's hash rate highlights the strength of its decentralized architecture, where miners play a crucial role in the network's continuous expansion. Alden notes that understanding Bitcoin's unique features is key to grasping its potential significance in modern finance. Even as profitability declines, miners are focused on a long-term vision, pushing forward despite the risks. Bitcoin mining requires significant financial investment and effort, and the increase in computational power in a challenging environment showcases the miners' resolve. The network is now 67.9% of the way to reaching the zettahash era, equivalent to 1,000 exahashes per second, a remarkable achievement given the current hash rate of 679 quintillion hashes per second. As Bitcoin's network continues to grow, a critical question arises: how will miners adapt? Will they keep pushing the limits of computational power, driving the hash rate even higher? And how might control of the ledger reshape the balance of power between individuals, institutions, and governments in the financial system? Share your thoughts in the comments below. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.